Hello students, welcome back to Accounting 2401 Principles of Financial Accounting. This is Dr. Mercado speaking. I hope all of you are having a wonderful week thus far. Now in this particular lecture we are going to continue covering Chapter 5, which deals with accounting for retail businesses, and in this particular lecture we are going to be covering problem 5-5A. Okay? Like I stated in my prior presentations and lectures, please make sure that you read before you attempt any of your assignments, as there is a lot of content in this particular chapter. Okay, we are transitioning from a service business to a retail business, so there's some things that do change. There's a lot of information provided, new accounts that are being added. It's just a wealth of information that we need to become familiar with. Okay, now this particular problem that I'm going to be covering over today with you deals with financial statements. Okay, regardless if it's a service or if it's a retail business, we still have to prepare financial statements. The process overall stays very much the same. It's just that we are introducing new accounts because, of course, in retail business, we do have actual physical inventory, whereas in service businesses, all we're doing is providing a service. Okay, so the main difference between the service and retail businesses when it comes with financial statements is the organization of the information, because like I stated, there are new accounts being added. So like if we see here for a service business, when we were doing our calculation for income, it was just basically your fees earned minus your operating expenses, and that will give you your income or loss. Now when we're dealing with retail businesses, we have more items that we need to account for. Okay, we're going to have our sales, our cost of goods sold. How much are we paying for the goods that we are buying? Okay, how much did we sell those goods for? Okay, what profit did we make, if any? Okay, after we calculate our gross profit, we need to deduct any operating expenses that we incurred to be able to arrive at our operating income. Okay, there's two types of income statements that are outlined in the textbook. One of them is a single step income statement, and the other is the multiple step income statement. Regardless of the income statement that you prepare, the output will be the same. Your operating income will still be calculated the same way. It's just the layout. The single step income statement basically just gets all of your revenues, deducts all of your expenses, and gives you your total operating income. Very similar to that of a service business, okay? It's just single step, revenues minus expenses gives you your operating income. Now, the multiple step income statement is more detailed. It has categories that we include or incorporate to kind of like organize the information, okay? We always begin with sales. This is the amount that you actually sell the goods for to your customers, okay? We have our cost of goods sold, okay? This is how much we are paying to purchase the goods that we are reselling, okay? Then the difference between the sales and the cost of goods sold will be your gross profit. Okay, this is the money that you made out of the sales. Okay. Well, operating income, also known as the income from operations, is basically determined by subtracting the operating expenses from the gross profit. So at this point, we have our sales minus the cost of goods sold give us our gross profit. After we calculate our gross profit, we deduct any operating expenses, and our operating expenses are classified into two categories. We have selling expenses and administrative expenses, okay? So it's very important that we know the difference between the two, okay? Selling expenses are incurred in the selling of the merchandise. Any expenses that you encounter to sell the merchandise. Examples include sales salaries, store supplies used, depreciation of store equipment, delivery expense, and advertising. Then we have our administrative expenses that are also called general expenses, okay? And some of these examples include office salaries, depreciation of office equipment, and office supplies used, okay? Each of the selling and admin expenses are reported separately, okay? So we have a category for selling and we have a category for admin expenses, okay? We also have another section for other revenue and expenses, okay? So if we have other revenues and expenses that are not related to the primary operations of the business, then we put them under other revenue. And basically other revenue is any revenue generated from sources other than the primary operating activity of a business, okay? So let's say that our business entails selling bicycles. Okay, so we are selling bicycles, and then we have an office that we're renting that has nothing to do with the sale of bicycles. So we are generating money off of that. That is another type of revenue. Okay, that has nothing to do with the sales of the bicycles. Okay, so that we would categorize it separately. Okay, examples of other revenue include income from interest, rent, and gains resulting from the sales of fixed assets. Okay, other expenses are any expenses that cannot be traced directly to the normal operations of the business. This can include interest expense and losses from disposal of fixed assets. Okay, and then for the other revenue and expenses, we have its own category that we report in the income statement. Okay, there is a wealth of information on your book dealing with financial statements. It goes over the basic, the single step income statement, the multiple step, the statement of stockholders' equity, and the balance sheet. Please make sure that you go over all of that information before you attempt your homework. Okay. Now, the problem that I'm going to be covering deals with preparing all of the necessary financial statements. Okay. I'm just going to give you a quick rundown because the financial statements are very similar to what we covered in chapters 1 through 4. It's just that now we are doing it for a retail business, okay? And the only difference is that we're going to be accounting for new accounts that have been created because now we actually have actual physical tangible inventory that we are selling, okay? So, it says, the following selected accounts and their current balances appear in the ledger of Claremont Company for the fiscal year ended May the 31st. Then we have all of these accounts that we're going to have to utilize for when we prepare our financial statements, okay? The instructions. We are to prepare a multiple step income statement. We're going to prepare a statement of stockholders' equity. They're letting you know that additional common stock of $75,000 was issued during the year ended May 31st. We're going to prepare a balance sheet assuming that the current portion of the note payable is $50,000. Okay, and we're going to briefly explain how multiple and single step income statements differ. Okay, so basically we're going to prepare the three primary financial statements: income statement, statement of owner's equity, and the balance sheet using the information provided. Okay, so they're asking us to prepare the income statement using the multiple step form. Okay, so this is basically the category that we're gonna be using. We're gonna have sales minus our cost of goods sold will give us our gross profit. We're gonna deduct any operating expenses to arrive at our operating income, and then we need to classify our expenses either as selling or admin expenses, and then identify if we have any other revenues and expenses. Okay, so let's get rolling with this problem because it is long. Okay, so the first thing that we always start off with when we are preparing our income statement is our revenue, and in this case our revenue account is our sales. Okay, so we're going to locate the sales, and what I'm going to do is I'm going to scratch them off as I use them. That way I make sure that I know that I've used all of them. Okay, so sales is $11,343,000. Because we only have one sales account, I'm going to bring that over to the very end. And let me format all of these to numbers. That way they are a standard. There we go. 11,343,000. Okay. Oh, because I formatted it won't let me put dollar signs, but that is fine. Okay. I just want them to look the same. Okay. Now we're going to go ahead and we're going to deduct our cost of goods sold. Okay. Cost of goods sold. So our cost of goods sold is provided at $7,850,000. Okay. So cost of goods sold is $7,850,000. Okay. That is going to give us our gross profit. Remember, we have a profit if our sales exceed our cost of goods sold. If our cost of goods sold exceed our sales, then we've got a loss. Okay. So here our revenue is greater than our expenses, so we're going to calculate our gross profit, and that's going to give us $3,493,000. Okay. Then we're going to bring in our expenses, okay? Remember, we have expenses and we have to classify them either as selling expenses or administrative expenses. Selling expenses, okay? So let's look at our expenses and let's see what falls under selling, okay? So here it says sales, salaries, expense. That has to do with sales. So that's part of a selling expense, okay? So let's mark that one off. Okay, we have a sales, salaries, expense. And we have $916,000, okay? We have advertising expense. That is part of sales. We want to make sure we advertise. We have advertising expense of $550,000. $550,000. Okay. Next, what do we have? We have depreciation expense on the store equipment. Okay. So that is part of the selling. We have a store, and that's part of us selling the goods. So we're gonna go ahead and we're gonna include that. $140,000. Depreciation expense, store equipment. That's $140,000. Okay. We have miscellaneous selling. The word here is selling. We're looking for all of our selling expenses. Miscellaneous selling expense, $38,000. We're going to include that. Miscellaneous selling expense. Okay. And that one is $38,000. Okay. And that is it. These are my sales related expenses. From here we start off with the office. Those are my admin expenses. So I'm going to go ahead and I'm going to get my total selling expenses. Okay. We're going to add those and we're going to take them to that center column. Okay. We're going to add everything here, and that gives me $1,644,000. Okay. Now we're going to start off with our administrative expenses. Okay. So for my admin expenses, I have my office salaries expense. Okay, I'm going to enter that there. And keep track of the accounts that you've used. Okay, that way you don't repeat. Okay. So we have office salaries expense, and my office salaries expense is $650,000. Okay. We have rent expense. That is an administrative. That is not related just to the selling. That's just a normal administrative expense. Okay, we have the rent expense of $94,000. Okay. Depreciation expense on the office equipment, because this is office related, that goes under admin expenses. Okay. Depreciation expense, office equipment. And that is $50,000. Okay. Okay. We have insurance expense. Okay. And insurance expense is $48,000. Insurance expense, $48,000. Okay. And we have office supplies expense. Remember, anything related to the office is an administrative expense. We have $28,100. And then last but not least, we have miscellaneous admin expenses. Miscellaneous admin expenses. Okay. And we've got 14,500. So all of that has been used up. Okay. So we have one more expense, but that is an interest expense. Interest expense has nothing to do with the operations of the business. It has nothing to do with what we're selling. Okay, we're going to tally up my total admin expenses. We're going to add those up. Okay, we're going to add them up. And that's going to give me $884,600. Okay. Now we can get our total operating expenses. This is how much we spend in the operations, both selling and admin. We're going to combine the $1,644,000 plus the $884,600. Okay. You know what? And I'm going to keep this consistent. In the real world, we don't use negative numbers. We use positive numbers. Okay. There. So sales minus cost of goods sold gives me my gross profit. And then we have all of our expenses. All of our expenses equal to $2,528,600. Now to calculate our operating income. Okay. To calculate our operating income, we're going to get our gross profit, which is the $3,493,000, and we're going to subtract our total operating expenses of $2,528,600. Once again, we get our gross profit minus our total operating expenses. That's going to give me my operating income of $964,400. Okay. Now we have one more thing that we have to account for. We have a category called Other Revenue and Expenses. Okay. And in that category, we're going to go ahead and we're going to include that interest expense. Okay. That is not related to the operations of the business, but it's still an expense that we have to account for. Okay. $21,000. Okay. $21,000. Okay. Oh, let me first itemize it. So we have interest expense. Interest expense of $21,000. There we go. And now we can calculate our net income. Okay. So my net income is going to be calculated by getting your operating income minus any other revenues and expenses. And that's going to give me net income of $943,400. Okay, let me save this. I don't want to lose it. Okay, so let's recap. Sales will always be the starting point. Sales is your revenue. Cost of goods sold, that is how much you spend on buying the products that you are reselling. That is an expense. So sales minus your cost of goods sold will give you your gross profit. This is how much you made by marking up the product. $3.4 million. Okay, $3,493,000. From there, we have to cover our selling and admin expenses, and those are segregated by the types of accounts. Selling expenses, the total is $1,644,000. Admin expenses, the total is $884,600. You add them together, and that will give you your total operating expenses of $2,528,600. To calculate your operating income, you get your gross profit of $3,493,000 minus the total operating expenses of $2,528,600, and that will give you your operating income of $964,400. You deduct any expenses that you incurred that are other expenses not associated with your operations of the business. If you had income, you would add the income. If you have expenses, you deduct the expenses. Okay. In this case, we have an expense. We're going to subtract. So we get our operating income of $964,400 minus the interest expense of $21,000. That will give you your net income of $943,400. Okay. Very similar. It's just identifying the categories where they fall under so we can be able to calculate the net operating income. Once we are done with the income statement, we can proceed to the statement of stockholders' equity. Okay. So we're going to begin with our balances as of June the 1st, 20Y1. Okay. So do we have any common stock? Okay. We have common stock. Okay. Let's see the following select amounts. Okay. Okay, so we have to be very careful. When we're preparing the statement of stockholders' equity, we had an additional common stock of 75,000 issued during the year ended May 31st. So, at the end of the year, we issued out 75,000 of additional common stock. Our total common stock is 500,000. Okay, so 500,000 was our beginning balance. Well, it's our ending balance, and we're going to deduct the 75,000 shares of stock that were issued at the end of the year. That will give us the amount that we had before this transaction that happened at the end of the year. Okay, so our beginning balance should have been 425,000. That is our current balance minus the $75,000 of stock that were recently issued. So my beginning balance will be $425,000. Okay, that is what we started off with initially. Okay, so let's mark that one that we've already used the common stock. Okay, now we have our retained earnings. Our retained earnings is our beginning balance, $2,949,100. We're going to bring that over, $2,949,100. And let me format this with the commas. Okay, $2,949,100. So we're going to use that one. And let's mark it off. Okay. And then we're going to get our total. We're going to add those two numbers together. And that's going to give me $3,374,100. Okay. Did we issue any common stock during the period? Yes, we did. The problem says that we issued, right here, we issued $75,000 of additional common stock. Okay, so during the period we added 75,000 more of stock. So my common stock is going to increase by 75,000. Okay, retained earnings does not get impacted, so we're going to get the total for that transaction. That gives me 75,000. Now we're going to bring in the net income. Okay. The net income comes from your income statement. Okay. The net income comes from your income statement. So we're going to go ahead and we're going to enter that net income under our retained earnings. We had net income of $943,400. Okay. We're going to get the total for that column. Okay. Okay. Did we have any dividends? Okay. Let's look over here. We had dividends of $100,000. Dividends of $100,000. So dividends affects our retained earnings and it decreases our retained earnings. Why? Because we're paying money out. So that means that your retained earnings are going to decrease. Okay. Oh, sorry. This is the sum only of this one. I'm getting ahead of myself. There we go. Dividends. Now we can get our ending balances as of May the 31st, 20Y2. Okay. We're going to get the totals from each column. Okay. So we have at the end, we started off on June the 1st with 425,000 in stock. We ended up with 500,000. My retained earnings, I started with $2,949,100 and I ended up with $3,792,500, mainly due to that income that we generated in the business. My total stockholders' equity is $4,292,500. Okay, so that is the end of our Stockholders Equity. In this particular in financial statement, there's no changes. Everything stays the same. From what we were preparing in chapters 1 through 4, the concept is still the same. Now we're going to prepare our balance sheet. Remember, our balance sheet basically balances our assets, liabilities, and stockholders' equity. Okay, so we're going to bring in all of our assets. Okay, so we're going to start off our balance sheet with our assets. We're going to start off with our current assets. Okay, these are any assets that we're going to use up or convert to cash within a year. Okay, we're going to start off with cash. Okay. Okay. So cash, we have $240,000. $240,000 of cash. And let me sort all this. Let me format it. Okay. So we've got cash of 240. Then we have our accounts receivable. Remember, accounts receivable, we should be collecting within 30 days. Okay. $966,000. So we have accounts receivable of $966,000. Okay. Next we have our inventory. This is a new account. Inventory is basically what you own in those goods that you're reselling. Okay. Inventory, that's an asset. Okay. And you should be selling those goods fairly quickly. Okay. Inventory. We've got inventory of $1,690,000. Okay. Next, we have our estimated returns inventory. That's the account that we set up an estimate of what we think is going to be returned. Okay. So we have our estimated returns inventory. And the amount we have is $22,500. Okay. Right here, estimated returns inventory. Okay. Next we have office supplies. So we're bringing in all of our current assets. Office supplies, we've got $13,500 in office supplies. Right here we have office supplies. Okay. Next we have prepaid insurance of $8,000. Prepaids are assets. We've got prepaid insurance of $8,000. Okay. Now, do we have any more assets? Let me mark this off. Okay, the next item we have is office equipment, $830,000. Okay. Remember, if it's something that's going to last us longer than a year, we put it in the category property, plant, and equipment. So from here down, we have a new section that we're going to use. So now we can tally up all of our total current assets. Total current assets. We're going to tally those together, and we're going to get a total. Okay. We have a total of $2,940,000 of current assets. Now we have our section property, plant, and equipment. Okay. So in this section, we're going to go ahead and we're going to bring in our office equipment of $830,000. Okay. The reason I'm putting it in the first column is because we have to make some calculations because of the depreciation. So we have to calculate the book value of each of the assets. Okay. So we're going to start off with the value of the asset, $830,000, and then we're going to deduct any accumulated depreciation. depreciation for the office equipment. Okay. And let's mark these off. My office equipment was already used. Now my accumulated depreciation on the office equipment is $550,000. That is how much we have depreciated this asset in our books. Okay, $550,000. Right there. Okay. Now that we have the cost of our assets minus the accumulated depreciation, we can calculate the book value. Book value of the office equipment. Okay. So to calculate the book value, we're going to get the 830 minus the 550. And that's going to give us a book value of $280,000 for the office equipment. Okay. The next one we have is our store equipment. We have $3.6 million of store equipment. Okay. Okay, so we're going to bring in our store equipment, $3,600,000. Let's go and mark that off. That way we know that we've used it. Okay. Then we have the accumulated depreciation for the store equipment, $1,820,000. That is how much we've depreciated that store equipment for. Accumulated depreciation, store equipment. The accumulated depreciation was $1,820,000. I forgot a 1, $1,820,000, 1, 2, 3, $1,820,000. There we are. Okay. So that is the accumulated depreciation. That's a deduction. Okay. So I have the store equipment valued at $3.6 million in our books. We have depreciated it $1,820,000. So now I can calculate the book value. The book value of the store equipment is going to be the $3,600,000 minus the $1,820,000. Okay, and that's going to give me a book value of $1,780,000. Okay, now we can get our total property, plant, and equipment. PPE, property, plant, and equipment. That way I don't write it all out. Okay, so my total property, plant, and equipment, we're going to add those two numbers together and get a total. The sum. Oh, sorry, I forgot to put the. I'm going to add the $280,000 plus the $1,780,000, and that's going to give me total property, plant, and equipment of $2,060,000. Now that I've got all of my current assets and my property, plant, and equipment, I can get my total assets total. Okay. To do that, I'm going to get my total current assets plus my total property, plant, and equipment, and that's going to give me total assets of $5 million. Okay. So we've already have all of our assets. Now we're going to move on to our liabilities. Okay. Liabilities, remember, is everything that we owe. This is our debt. Okay, let me mark the accumulated depreciation. That way we know that we've used it. Okay. So now, like I was saying, we are going to bring in all of our liabilities. This is everything that we owe. Basically, if it has the word payable on it, that means it's a liability. So we're going to have our liability section. Okay, and we're going to have current liabilities and long-term liabilities. Okay, current liabilities are anything that you're going to pay within a year or less. Okay, the first current liability that we have is our accounts payable. We have $321,000 of accounts payable. Okay, so we have $321,000. Okay, insert shapes. So we're going to mark off our accounts payable of $321,000. Okay. Now we also have salaries payable. Okay. We have salaries payable. And my salaries payable were $41,500. Okay. That is right here, salaries payable. Okay. Customer refunds payable, that's the next one we have. Customer refunds payable. And the amount of my customer refunds payable was $40,000. Okay. Basically, anything that has the word payable is a liability. We need to pay that money. Payable. Okay. Estimated coupons payable. Okay. So let's have, that's our next one. Estimated coupons payable. The amount of my estimated coupons payable is $5,000. Okay. So we have a total of $5,000 in estimated coupons payable. So we're going to go ahead and we're going to add that to our liability section. So there we go. Okay. And then let's look at this one carefully. It says notes payable. Final payment due in 6 years. So this note is going to be due for the next 6 years. So this makes it a long-term liability. Long-term because it's more than a year. Now, if we look at the problem, it says here that the note payable is $300,000, but $50,000 of it is going to be a current portion of the note. So that means that $50,000 is going to be due within the next year. So we need to break that $300,000 up into two. $50,000 is a current liability. The rest, which would be $300,000, minus the $50,000, that portion that is current, that means that $250,000 will be long-term liability and $50,000 will be current liability. Okay, so let's split that up. First, we're going to put in the current the current liability portion. So we're going to put note payable. Okay, and we're going to put here the current portion. And the current portion was $50,000. Okay, so that would basically be the last amount, okay, of our current liabilities. Remember, these are any liabilities that we're going to pay in less than in a year or less. Okay, so we're going to add those together, and that gives me $457,500. Okay, next we're going to bring in our long-term liabilities. These are any liabilities that are going to take us longer than a year to pay off. Okay, and according to the problem, we have one long-term liability worth $300,000 that is going to be due in 6 years. $300,000 is the total. $50,000 is the current portion. So that means that the long-term portion will be the $250,000. The $300,000 minus the current portion of $50,000. That means we have a long-term payable of $250,000. Okay, so my long-term liabilities, I'm going to have my note payable, and this is long-term portion. Okay, so that's going to be $250,000. So, okay, let me add a little bit more here. Okay, so then that's what we have. Now that we brought in our current liabilities and our long-term liabilities, we can get our total liabilities. Okay, my total liabilities is going to be my $457,500. That is my total current liabilities, and then my $250,000. I'm going to add my $250,000, which is my long-term liabilities. I forgot to label this total current liabilities. Okay, so my total current liabilities is $457,500. This represents the amount that we must pay within a year or less. We have the long-term liability. This is anything that we have to pay above a year. We have $250,000 worth of long-term liabilities. My total liabilities will be $707,500. Okay, so this is my liability section. Okay, $707,500. Okay, let me mark this another color. Okay, the next section we have is our stockholders' equity. Excuse me. A stockholders' equity. Okay, and I'm going to need more lines down here. Okay, so for my stockholders' equity, I am going to begin with my common stock. Now, where are we going to get these numbers? Okay, let me mark this off right here. Okay, so I've already used that 300,000. Okay, so I've already used up all of my assets. I've used up all of my numbers. Okay, so that means that the information from my balance sheet for my stockholders equity section is not coming from here. Where is it coming from? It's coming from your statement of stockholders equity section. Okay, so common stock. Okay, we're going to pick up this number right here, that 500,000 from your statement of stockholders equity. That is going to go from here. We are going to bring it down. We're going to bring it down all the way over here. Okay, so your common stock is $500,000, and we're going to bring it over 500,000. Okay, next we have our retained earnings. Okay, your retained earnings is coming from right here. This is from the statement of stockholders equity. We are getting the total $3,792,500. Okay, so that number is going to flow as well all the way to the bottom. Okay, all the way down here. Okay, so we're going to have $3,792,500. Okay, so our total stockholders equity will be the sum of those two. We're going to add them together. That'll be $4,292,500. That number right there, that $4,292,500, is what we have in our statement of stockholders equity as our total, $4,292,500. So that number goes in our balance sheet. Okay, right there. Okay, so that gives me my total. Now I can get my total liabilities and stockholders equity. Okay, how are we going to do that? We're going to add our total liabilities of $707,500 plus my total stockholders equity of $4,292,500, and that's going to give me my total liabilities and stockholders equity of $5 million, which needs to equal to my total assets, which it does. So my total assets are $5 million. My total liabilities and stockholders equity are $5 million. Okay, so my balance sheet is in balance. Okay, just remember your stockholders equity section is coming from your statement of stockholders that you just prepared. Okay, everything else comes from the data provided. All you have to basically do is plug it in either on the income statement if it's a revenue or an expense, or on your balance sheet if it's an asset liability. Okay, and stockholders equity. Okay, so that is basically the three financial statements that we have to prepare. Those are requirements 1, 2, and 3. Now for requirement 4, okay, it says briefly explain how the multiple and single step income statement differ. And basically, I'm not going to type it out, I'm just going to explain it verbally. Y'all can listen. Basically, the multiple step form of the income statement contains the various sections as we can see here. Okay, the various sections of revenues and expenses with intermediate balances. So we have total selling, total admin, all of that good stuff. And then it concludes with your net income. Okay, in a single step form, the total of all of the expenses is deducted from the total of all of the revenues, and there are no intermediate balances. So it's basically just like what we were doing before. Revenues minus, you list all of your expenses, and then you get your net income. The multiple step form of the income statement categorizes the expenses between selling and admin, and then it breaks off any other revenues and expenses that are not related to the operations of the business. So it's just better organized. That way we want to see, hey, how much are we spending on selling expenses? Well, our selling expenses are 1.644 versus 884,600 of admin expenses, okay? So that way you have more detail base because we're grouping these according to the categories provided, okay? But the overall results, whether you use the multiple step or the single step, is the same. You should still arrive, if you're using the same figures, you should still arrive at the same net income, okay? So this is an example of the three financial statements. I hope that this helps you when you are completing your homework, and it helps you basically visualize and understand the differences between preparing financial statements for a service company and for a retail business. Okay? If you have any questions or concerns, do not hesitate to contact me. Please review your syllabus for my scheduled office hours. And that is it for Chapter 5 lectures. Until next time, have a wonderful rest of your week.